Welcome to the deep dive. So, you're stepping into the world of California real estate. That's fantastic. But then, yeah, you hit the financing part,
Hmm.
and suddenly that sunny California landscape, it can start to feel, well, less like golden hills and maybe more like a really dense, confusing forest, full of forms, weird terms,
It
regulations.
absolutely can.
Yeah.
Financing is, well, it's arguably the most complex piece for most clients. And honestly, for a lot of agents when they're just starting out too,
Right?
it's where the jargon gets really thick
Yeah.
and it's where misunderstandings can cause, frankly, the most stress.
You got that right.
Yeah,
But listen, this deep dive, we're aiming to cut right through that confusion. We've gathered up the source materials, the articles, the regs, the insights, and our mission today is pretty straightforward.
yeah,
We want to demystify the fundamental concepts of real estate financing,
yeah.
specifically for you as you're navigating your path in California real estate.
Think of it as your essential map. We're going to tackle the common loan types your clients will likely run into. We'll clarify those really critical legal instruments that secure the loans.
With that vital California focus.
Exactly, with the California focus. And we'll dive into the must-know federal consumer protection laws. Things like TILA, the Truth in Lending Act, and RESPA, the Real Estate Settlement Procedures Act.
And look, this isn't just about cramming facts for an exam, understanding financing. It's really about empowering yourself.
Totally.
It's about being able to guide your clients confidently through what is, let's face it, often the most anxiety-inducing part of buying or selling a home. You get to be that trusted resource who can actually restore their peace of mind.
So let's not just, read about financing. Let's dive deep into what it really means in practice. Let's unpack the mechanics, the regulations,
Yeah.
the stuff that actually makes homeownership possible.
All right, let's start right at the beginning then. The fundamental why. Why do most people even need a loan to buy a home? Seems obvious, maybe, but let's break down the economics a bit.
Well, the simple reality is the price of real estate. I mean, especially in high-value markets like we have here in California.
Yeah.
It's typically far, far beyond the cash savings of most individuals or families. Just trying to pay for a home outright, with cash, it's just not feasible for the vast majority of buyers. And that's where mortgages or home loans come into play. They bridge that massive financial gap.
So instead of needing, I don't know, maybe $1 million cash for a home, a mortgage lets someone put down a smaller, more manageable percentage, like that classic 20% down payment we always hear about.
Exactly.
Yeah.
Yeah, well, 20% down is often seen as kind of a benchmark, especially if you want to avoid private mortgage insurance on conventional loans. Financing actually allows purchases with much lower down payments.
How low?
We're talking as low as 3.5% or even 0% down for certain government-backed programs we're going to get into. The loan provides the rest, the 80%, 96.5%, or sometimes even 100% of the purchase price.
Got it. So the loan makes homeownership accessible.
Yeah.
Okay. But the lender, they're not just handing out huge sums of money to, well, just anyone, right? There's a process.
Oh, absolutely. The lender is taking on significant risk here. I mean, they're fronting a large amount of capital. So naturally, they have to assess the borrower's ability and, importantly, their willingness to repay that debt.
Right.
And that happens through the application and the underwriting process. Not everyone who applies for a loan is going to get approved.
Underwriting. Okay, so that's where the lender really digs into the borrower's financial life.
Mhm.
What are the key things they're looking at during that process based on the sources?
Well, the sources really point to three main pillars that lenders evaluate, to determine eligibility and risk. First off, sufficient and reliable income relative to debts.
Okay.
Lenders look at your gross monthly income and they compare it to your existing monthly debt payments, things like car loans, student loans, credit card minimums, plus the proposed new housing payment. Principal, interest, taxes, insurance.
That's the DTI ratio, right? Debt to income.
That's it, often expressed as DTI, comparing what's coming in versus what's going out each month.
Okay, that makes sense. So income versus debts. What's the second pillar?
Second is having acceptable levels of debt overall. This isn't just about the monthly payment ratio, the DTI, but also the total amount of debt someone's carrying. High existing debt can signal higher risk to the lender.
And the third pillar, I'm guessing credit history plays a big part here.
Precisely. Third is having a credit score that meets the lender's requirements. A credit score is basically a numerical snapshot of your creditworthiness. It's based on your history of borrowing and repaying debt.
Higher score, lower risk.
Generally, yes. A higher score usually indicates lower risk to the lender. And it's really worth noting here, while programs like FHA and VA might set certain minimum credit scores, the private lenders who actually originate these loans. They can, and often do, have higher requirements than the program minimums.
Ah, okay. So the lender might be stricter than the government program itself.
Can be, yeah.
So income, debt, and credit score. Those are the big three factors determining if someone qualifies, and I assume what kind of interest rate they get offered.
Exactly. The interest rate on the loan is pretty much a direct reflection of how the lender assesses the borrower's risk. Borrowers who seem higher risk, maybe lower credit scores, higher DTI, less stable income, they'll generally be offered higher interest rates. That's to compensate the lender for taking on that extra risk.
And lower risk borrowers get better rates.
Lower risk borrowers qualify for lower rates. Simple as that.
Okay, so the borrower gets approved, the terms are set, including the rate, they get the money. Now, what's the absolute core legal document where the borrower actually promises in writing to pay that money back?
That document is called the promissory note. You can think of it as the formal, legally binding IOU. It's the borrower's written promise to repay the specific amount they borrowed under the exact terms agreed upon.
It's the heart of the debt itself, really. What kind of details are actually in that promissory note?
Well, the promissory note spells out all the key terms. Things like the face amount, that's the principal amount, borrow the interest rate, and critically, whether it's fixed or adjustable. It details the payment schedule, how often payments are made, when they're due, the loan term, how long you have to repay it, and importantly, the consequences if you default.
Okay.
For a standard mortgage, that face amount is the initial loan balance. But for something like an open-end credit plan, say a home equity line of credit or HELOC, the sources mentioned the face amount actually represents the total credit limit available to borrow against.
Got it. So the promissory note is the promise to pay, but what happens if the borrower doesn't pay? How does the lender protect themselves, make sure they can get their money back?
This is where the property itself becomes key. The property serves as the security. It's the collateral for the loan.
Okay.
The borrower gives the lender a legal interest in the property, and that allows the lender to, if necessary, take the property and sell it to satisfy the debt if the borrower defaults on that promissory note.
And the legal paperwork that creates this security interest, that's where mortgages and deeds of trust come in.
Exactly. Those are the two main instruments used for securing real estate loans: the mortgage and the deed of trust.
Right. And people often use those terms interchangeably in casual conversation, but legally, they are definitely not the same thing. Especially here in California, understanding the difference is vital.
It truly is. Let's break down the parties involved, because that's where the fundamental difference really lies.
Okay. So in a traditional mortgage, you've got two parties. The borrower is the mortgagor.
Right.
And they give a lien, a claim on their property to the lender, who is the mortgagee, but the borrower keeps legal title to the property.
Correct. The lender has that lien, giving them the right to foreclose if things go wrong. Now compare that setup to a deed of trust.
A deed of trust involves three parties. There's the borrower, who we call the trustor. There's the lender, called the beneficiary. And then there's this neutral third party, called the trustee.
And here's where the structure makes all the difference. In a deed of trust, the trustor, that's the borrower, actually transfers a limited form of legal title, sometimes called naked legal title or bare legal title, to the trustee. The trustee holds this title, but they hold it for the benefit of the beneficiary, the lender. Meanwhile, the borrower keeps the right to possess and use the property, and critically, the right to get full legal title back once the loan is fully paid off.
Interesting. So the trustee technically holds the title, sort of in trust, for the lender's benefit, while the borrower lives there, uses the property, makes payments.
Exactly. It's a different structure than the two-party mortgage system.
CA corner alert. And here is the absolute key takeaway for everyone listening who plans to work in California. California overwhelmingly uses the deed of trust system, not mortgages.
This is absolutely foundational knowledge for practicing real estate here. Understanding that you are almost always dealing with a deed of trust is crucial. Why? Because this three-party structure dictates the foreclosure process if a borrower defaults.
Which is another huge difference, right? In states that primarily use mortgages, foreclosure usually requires going to court. A judicial process?
Correct. A judicial foreclosure is essentially a lawsuit. The lender has to go to court, ask a judge for permission to sell the property to get their money back. It can be a pretty lengthy process.
Okay.
But with a deed of trust, because that trustee holds that bare legal title, the foreclosure process typically uses a non-judicial process.
Non-judicial, meaning generally it happens outside of the court system.
Precisely. The deed of trust document itself contains a clause, usually called the power of sale clause.
Power of sale.
Yeah. This clause gives the trustee the power, the authority, to sell the property at a public auction. They do this on behalf of the beneficiary, the lender, if the borrower defaults. And critically, they generally don't need court approval to do it.
Wow. So if the borrower stops making payments, the trustee, holding that title and having that power of sale, can initiate a foreclosure sale by following specific legal steps, but they don't have to file a lawsuit and get a judge's okay first.
That's the core difference. Now, there are very strict notice requirements and procedures the trustee absolutely must follow, but it bypasses the court system that a judicial foreclosure under a mortgage typically requires.
It's different. Mortgage versus California deed of trust, judicial versus non-judicial foreclosure. Why is this something you have to get as a California agent?
Well, look, it impacts everything. Default timelines, the legal standing of the homeowner when they're in distress. Your clients might come from other states where they only know mortgages and expect a long court process, or they might just be confused by the terminology truster, beneficiary, trustee.
Right.
You need to be able to explain clearly and calmly, look, here in California, the deed of trust is standard, and this structure allows for a faster non-judicial foreclosure if payments are missed. You're not giving legal advice, obviously, but you are giving them accurate info about how their loan is secured in this state.
Yeah.
It's a key piece of California-specific knowledge, and explaining it well really builds trust.
That makes so much sense. It's not just some academic point. It has real-world consequences for your clients if they hit a rough patch. Okay, so we get the promise to pay, the note, and how it's secured, the CA deed of trust. Now, let's look at the different kinds of loans buyers might actually use, because not everyone fits the same mold.
Exactly right. Borrowers have vastly different financial situations, different needs, different qualifications. So naturally, there's a range of loan products designed to meet those different circumstances. Based on the materials we look at, the most common types you'll likely encounter are conventional, FHA, and VA loans.
Let's start with conventional loans. What makes a loan conventional?
Okay, conventional loans are basically mortgage loans that are not insured or guaranteed by a government agency. So unlike FHA or VA loans, they're originated and funded by private lenders.
Yeah.
Banks, credit unions, mortgage companies. Because there's no government backing, the requirements are set by the lenders themselves and often by the big secondary market players like Fannie Mae and Freddie Mac, who might buy these loans later. Though the sources didn't go deep into the secondary market, that's kind of the engine behind conventional standards.
Got it. So they're the standard non-government loans. What are the typical requirements, generally speaking?
Well, specifics always vary by lender, but conventional loans usually require a higher credit score compared to government-backed options like FHA. Borrowers generally need stronger credit histories, lower debt-to-income ratios. Down payment requirements can also vary quite a bit. You might see some programs with as low as 3% down, but that 20% down figure is often preferred because it helps you avoid paying private mortgage insurance or PMI.
Okay, PMI. We'll come back to insurance. So conventional is generally for borrowers with stronger credit and financials. Now, what about FHA loans?
FHA loans are a really important tool, especially for certain buyers. These are loans insured by the Federal Housing Administration, that's part of HUD, the Department of Housing and Urban Development. That FHA insurance protects the lender if the borrower defaults.
And what's the main goal of FHA loans? Who are they really designed for?
The primary purpose is to make homeownership more accessible, particularly for folks like first-time home buyers, families with low to moderate income, or maybe people whose credit isn't perfect. Because the FHA insures the loan, lenders can be a bit more flexible with their qualifying criteria.
More flexible in what ways? What are the key points on eligibility and down payment, according to the sources?
Okay, based on the FHA versus VA comparison and other materials, FHA loans are generally available to the public. Anyone can potentially qualify. It's not restricted to a specific group like veterans. The key flexibility comes down to down payment and credit scores.
How low can you go?
A borrower might qualify with a minimum credit score of 580 and only need to put down 3.5%. Now, if their credit score is lower, say between 500 and 579, they might still qualify, but they'll need a larger down payment, at least 10% down.
Wow, so even a 500 credit score could potentially get an FHA loan with 10% down. That's a pretty big advantage over conventional for some buyers.
It can be, yes. Although, again, always remember that the private lender actually making the loan might have their own extra requirements, what they call overlays. They might require a higher credit score than the absolute FHA minimum.
Good point.
Best practice is always to have clients talk to a lender early on, figure out exactly what they qualify for with that specific lender.
Makes sense. Are there specific rules about the property itself for FHA?
Yes, definitely. The property being bought with an FHA loan has to be the borrower's primary residence, so no investment properties or vacation homes. And the property also has to meet FHA's minimum property standards, basically ensuring it's safe, structurally sound, and sanitary.
Okay. And the cost side. We mentioned mortgage insurance. How does that work with FHA loans? Is it like PMI?
FHA loans require mortgage insurance, yes,
Okay.
and the borrower pays for it. It actually has two parts. There's an upfront mortgage insurance premium, UPMIP, which is usually either financed into the loan amount or paid at closing. And then there's an annual mortgage insurance premium, MIP, which is paid monthly as part of the mortgage payment.
Okay. Upfront and ongoing.
Right. And the sources highlight a really key downside here for borrowers. For most FHA loans originated today, that annual MIP is required for the entire life of the loan. Doesn't matter how much equity you build up.
Wait, forever. Unlike PMI on conventional loans.
Exactly. PMI on conventional loans can usually be canceled once the borrower hits about 20% equity, maybe 22% loan to value. But FHA MIP, for most borrowers getting loans now, sticks around for the long haul. That's a critical difference for clients to understand in terms of the long-term cost.
Definitely. And FHA loans also have limits on how much you can borrow, right?
Yes, they do. FHA loan limits vary quite a bit depending on where the property is located. For 2025, the sources indicated they range from a floor of $524,225 in lower-cost counties up to a ceiling of $12,209,750 in high-cost counties for a single-family home. These limits get updated annually and are based on housing costs in that specific area.
Okay, good to know. That covers FHA. Now let's shift to VA loans. These are specifically for veterans and service members.
That's right. VA loans are guaranteed by the U.S. Department of Veterans Affairs, the VA. They're designed to help eligible U.S. veterans, active duty service members, members of the National Guard and Reserves, and also certain eligible surviving spouses buy homes. And they come with some really unique benefits.
So eligibility is the first hurdle. How does someone prove they're eligible? What about a surviving spouse?
Eligibility is based on specific service requirements set by the VA. To prove it, borrowers usually need what's called a Certificate of Eligibility, or COE, directly from the VA. For eligible surviving spouse, the sources mentioned they typically need to provide documents like their marriage license, the veteran's death certificate, or maybe a DD Form 1300, which is a report of casualty, and the veteran's separation paperwork, like the DD 214. These docs help the VA confirm their eligibility status and issue that COE.
Got it. And the most famous benefit of a VA loan?
Ah, the big one. The signature benefit is the possibility of putting $0 down. $0 down payment.
Wow.
For eligible borrowers who have their full VA entitlement available, the VA guarantee often allows them to purchase a home with literally no money down, as long as the purchase price isn't more than the property's appraised value.
$0 down is huge. What about credit score requirements for VA loans, similar to FHA?
Interestingly, no. The VA itself actually does not set a minimum credit score requirement. However, just like with FHA loans,
The private lenders do.
the private lenders who actually provide the funding do impose their own minimum credit score requirements. The sources mention that lenders typically require a minimum credit score of at least 620 for a VA loan.
Okay, so VA says no minimum, but the lender likely needs a 620 or higher. What about property requirements?
Similar to FHA, the property has to be the borrower's primary residence, and it also has to meet the VA's minimum property requirements, or MPRs, again ensuring it's safe, sanitary, and structurally sound.
And fees. Is there mortgage insurance like FHA?
No, and this is another major benefit. VA loans do not require private mortgage insurance or any kind of ongoing monthly mortgage insurance premium. That's a huge cost saving compared to both FHA and many conventional loans with less than 20% down.
So what's the catch? Is there a fee?
Instead of mortgage insurance, VA loans have something called the VA funding fee. This fee helps the VA keep the program running and basically reduces the cost to taxpayers. The amount of the funding fee varies. It depends on the borrower's military service category, how much they put down, if anything, and whether it's their first time using the VA loan benefit or a subsequent use. It can be paid upfront at closing, or often it's financed right into the loan amount.
Okay, so no ongoing monthly insurance, but there is that one-time funding fee. What about loan limits for VA? Are they capped like FHA?
For eligible borrowers who have their full entitlement available, the VA generally sets no loan limit.
No limit.
No VA loan limit. This means they could potentially borrow the full amount needed to buy a home, even very expensive ones, provided the lender approves them for that amount, and of course the property appraises for the value. Now, if a borrower has only partial entitlement left, maybe they used their VA benefit before and haven't fully restored it, then loan limits based on conforming loan limits in their area might apply.
That's a really powerful benefit, especially for veterans buying in high-cost areas like California.
Wow. So comparing FHA and VA, you can really see how they target different groups with specific advantages.
Yeah.
FHA offers broader access with credit and down payment flexibility, but
Mm.
has that ongoing insurance cost. VA offers the incredible $0 down potential and no monthly insurance for eligible service members, but has the funding fee.
Absolutely. Understanding these key distinctions is just vital for helping your clients explore their potential options. And, the sources also briefly mentioned a few other loan types that often get treated as exceptions and regulations. Things like reverse mortgages, which let older homeowners tap into their equity.
Right.
Temporary or bridge loans, usually 12 months or less, often used to buy a new place before selling the old one. And construction-only loans, just for funding the building process itself.
And home equity loans, too, using the home's equity as collateral. Yes, home equity loans or ELOCs. They let you borrow against the equity you've built up. The sources noted the interest rate is often better than, say, credit cards. And importantly, the IRS rules say the interest might be tax deductible.
Yes.
If the loan proceeds are used to buy, build, or substantially improve the home that's securing the loan, that potential tax deduction is often a big draw for homeowners considering that route.
Okay, so a whole toolkit of financing options out there. Now let's shift gears. We need to talk about the crucial legal framework that's designed to protect consumers through this whole complex financing maze. TILA and RESPA. They can sound, well, a bit intimidating with all the
You
acronyms.
can. TILA-RESPA, Reg Z, Reg X.
Yeah.
But honestly, they are the consumer's best friend in the lending world. And because of that, they need to be your best friend as an agent in terms of really understanding them. Getting a handle on these regulations empowers you to guide your clients ethically and confidently. Let's start with TILA. That's the Truth in Lending Act, and its rule is Regulation Z.
Okay, TILA and Red Z. What's their main mission? What are they trying to achieve?
TILA's primary purpose, its core mission, is to make sure consumers get clear and conspicuous disclosures about the costs in terms of credit. The whole idea is to help people compare credit offers effectively, apples to apples, and really understand what they're signing up for financially.
And what are the key ways TILA shows the cost of credit? How does it make it clear?
TILA uses two really crucial concepts: the finance charge and the annual percentage rate, or APR.
Finance charge and APR.
Finance charge is the total cost of getting that credit, expressed as a dollar amount. It includes the interest you'll pay over the life of the loan, but usually also other charges the lender requires as part of giving you the credit. Things like discount points, maybe mortgage insurance premiums, some loan origination fees.
What does it not include?
Generally, it excludes costs that you'd pay even if it were a cash deal.
Yeah.
Things like property taxes, title insurance fees, recording fees, appraisal fees, unless the creditor specifically requires them as a condition of getting the loan.
Okay, so the finance charge is the dollar cost of borrowing. What about the APR?
The APR, the annual percentage rate, is the cost of credit expressed as a yearly rate. It takes that finance charge, factors it in over the loan term, and gives you a standardized percentage rate. It reflects not just the basic interest rate, but the overall cost of borrowing when you include certain fees. It's designed specifically to be a comparison tool across different loan offers. Regulation Z has very detailed rules on exactly how to calculate and disclose both the finance charge and the APR.
And Regulation Z also gets into specific rules for certain kinds of loans, right? Like adjustable rate mortgages or maybe really high cost loans.
Yes, absolutely. For adjustable rate mortgages, or ARMs, TILA requires specific disclosures explaining exactly how the interest rate and the payments can change over time. And for what are called high-cost mortgages, these are loans where the interest rate or the total points and fees exceed certain thresholds set by HOPA, the Homeownership and Equity Protection Act.
WEPA, that's part of TILA.
Yes, HOPA is an amendment to TILA. And for those high-cost mortgages, the rules get much, much stricter.
Stricter how? What kind of extra rules does HOPA slap on these high-cost loans?
HOPA brings in some significant consumer protections. It puts limits on certain fees and loan terms. It includes a very strong requirement for the lender to assess the borrower's repayment ability. They have to make a reasonable good faith determination that the consumer can actually afford to repay the loan based on its terms.
Makes sense.
And in many cases, HOPA mandates homeownership counseling before the loan can even be made.
Mandatory counseling. Wow. The sources mentioned that. That sounds like a serious protection.
It really is. For these high-cost mortgages, the lender cannot close the loan unless they get written proof that the consumer has received counseling from a HUD-approved homeownership counseling agency.
When does the counseling happen?
It has to happen after the consumer gets the initial REPA disclosures about the loan potentially being high cost. And the counselor can't be affiliated with the lender. Now, the lender can pay the counseling fee, but they can't make the loan conditional on the consumer using one specific counselor or even on the loan actually closing after the counseling session. It's really designed to make sure the consumer fully understands the risks involved before they commit.
Okay. Regulation Z also gets into how loan originators get paid, doesn't it, to avoid conflicts of interest?
Yes, that's another key area. Regulation Z includes rules to prohibit certain loan originator compensation practices. Specifically, practices that could incentivize someone to steer a consumer into a particular loan just because the originator gets paid more, rather than because it's truly the best loan for the borrower. Well, the sources specifically mention the prohibition of dual compensation in many situations. That generally means if a loan originator gets paid directly by the consumer, they usually can't also get paid by someone else in the transaction, like the creditor. And compensation structures generally can't be based on the loan terms themselves in a way that incentivizes making riskier or more expensive loans. Pay is often tied to the loan amount, but carefully regulated.
Got it. Okay, so TILA and Red Z are all about transparency in the cost and terms of the loan itself. Now let's flip to the other big one, RESPE, the Real Estate Settlement Procedures Act, and its rule is Regulation X. What's our RESPE's main focus?
RESPE zeroes in on the settlement process. That's basically everything involved in actually closing the loan transaction. Its main goals are, 1, to give consumers timely information about the cost they'll have to pay at closing, 2, to eliminate illegal kickbacks and referral fees that unnecessarily inflate those settlement costs, and 3, to set rules for how mortgage loans are serviced after the closing happens. RESPA mostly applies to what are called federally related mortgage loans, which covers the vast majority of loans secured by a lien on a 1-to-4 family residential property. So, most home loans.
Transparency at closing, rules for servicing after closing, and eliminating kickbacks. Let's zoom in on those kickbacks. Section 8 of RESPA sounds really important here.
Section 8 of RESPA is absolutely fundamental for anyone working in the real estate business. It lays down a strict prohibition against kickbacks and unearned fees. The law is very clear. No person shall give or accept any fee, kickback, or thing of value simply for the referral of settlement service business.
Thing of value is broad.
Very broad. It also prohibits splitting charges for services that weren't actually performed.
Ethical compass. Let's bring this home. Why is Section 8 of RESPA so critical for you, the aspiring agent? What does this mean in plain English day to day?
Look, it means you absolutely, positively cannot accept payment, whether it's cash, a gift card, fancy dinners, tickets, whatever, from a lender, a title company, an escrow company, a home inspector, anyone providing settlement services, just for sending them a client.
Just for the referral.
Just for the referral. Offering or accepting referral fees is flat out illegal under federal law. Any money you receive from one of these providers has to be for actual services you performed in that transaction, not just for pointing the client their way. And this holds true even if the service provider is somehow affiliated with your brokerage or another company you might have an interest in.
So if a lender offers you, say, $500 cash for every buyer you refer who ends up closing a loan with them, that's a huge red flag, a clear violation of RESPA Section 8.
Crystal clear violation. And the penalties can be really severe. We're talking hefty fines, even potential imprisonment. But honestly, beyond just staying out of legal trouble, sticking to adulation, Section 8 is just the bedrock of ethical practice. Your job is to help your clients find the best services for their needs based on quality, cost, reliability, not based on who's slipping you a fee under the table. It's about putting your client's interests first, period. Understanding and strictly following Section 8 builds trust and protects everyone involved.
Okay, that anti-kickback rule is crystal clear. Non-negotiable. What else does RSPA cover, especially after the loan closes? You mentioned servicing rules.
Yes, Regulation X under RSPA has extensive rules covering mortgage servicing. This governs how the company that collects your client's payments and manages their loan, the servicer, has to handle things.
Like the escrow accounts for taxes and insurance, people always have questions about those.
Exactly. Servicers have to manage those escrow accounts properly. They need to make timely payments for property taxes, homeowners insurance, and anything else being escrowed using the funds in the account. They're required to conduct an annual escrow analysis to make sure they're collecting the right amount, and they have to provide the borrower with an annual statement detailing everything.
What if the analysis shows they collected too much or too little?
There are specific rules for handling surpluses, shortages, or deficiencies in the escrow account, outlining how the servicer can collect shortages or return surpluses. And when a loan is fully paid off, any money left in the escrow account generally has to be returned to the borrower within 20 business days. The sources also mentioned that TILA rules actually require an escrow closing notice if the escrow account gets canceled, either by the servicer or the borrower.
Okay. What if a client calls you after closing, maybe months later, and says, hey, I think my servicer made a mistake on my statement. They charged me a weird fee, or they didn't apply my payment right.
That falls under RESPA's error resolution procedures. If a borrower sends their servicer a written notice, it usually has to be written outlining a potential error in their loan servicing. The servicer has rules to follow. They generally have to acknowledge they received it within 5 business days.
Okay.
Then they have specific time frames to investigate and respond. Usually it's 30 business days, maybe with a 15-day extension possible, to either correct the error or determine that no error occurred and explain why, providing supporting documents. For certain types of errors, like ones involving payoff amounts or foreclosure timing, the deadlines are even shorter.
And what if the client just needs information, like, who's my hazard insurance provider on file, or can I get a copy of my payment history?
That's covered by RESPA's information requests rules. Similar process. If a borrower sends a written request for specific information about their loan servicing, the servicer generally has 5 business days to acknowledge it and 30 business days, again with a possible 15-day extension, to provide the information or explain why they can't. Servicers are actually required to designate a specific address for receiving these kinds of written error notices and information requests.
Got it. What about that situation where maybe a borrower lets their homeowner's insurance lapse and the lender steps in and buys insurance for them? That's called force-placed insurance, right?
Correct. Force-placed insurance. And ISP has rules for that too. Servicers can't just slap that charge on. They have to follow specific notice requirements before they can charge a borrower for force-placed hazard insurance. They need to send an initial notice, then a reminder notice.
And if the borrower gets their own insurance again?
If the borrower later provides proof that they actually had the required coverage continuously, the servicer has to cancel that force-placed policy and refund any overlapping premiums within 15 days. They have to remove those charges. And any charges for force-placed insurance have to be for coverage that was actually obtained, and the cost must be bona fide and reasonable.
Okay. And what if a borrower starts falling behind on payments? Does RTA say anything about how servicers should interact with them early on?
Yes, very much so. Under the early intervention requirements, generally, when a borrower becomes delinquent, meaning a payment is due and hasn't been paid, the servicer has to make a good faith effort to establish live contact with the borrower, usually no later than the 36th day of delinquency.
Live contact, like a phone call.
Yeah, ideally a phone call or an in-person meeting, if appropriate. The goal is to connect early, and promptly after making contact, they should inform the borrower about any available loss mitigation options that might help them get back on track, if appropriate for the situation. It's about early outreach before the problem gets too big.
And loss mitigation. That covers things like loan modifications, forbearance, repayment plans, ways to avoid foreclosure.
Precisely. RESPA includes detailed rules for evaluating loss mitigation applications. For example, if a servicer gets a complete application for loss mitigation from a borrower 45 days or more before a scheduled foreclosure sale, they generally must evaluate that application according to specific criteria before they can proceed with the sale.
Okay.
Servicers also have to exercise reasonable diligence to get any information they need for the evaluation that isn't directly in the borrower's control. They can't just deny an application because they're missing a document if they didn't make reasonable efforts to obtain it themselves.
What happens if the company managing the loan changes? The borrower starts sending payments to a new company, servicing transfers.
RESPA requires notice for that too. Both the old servicer, the transferor, and the new servicer, the transferee, generally have to send notices to the borrower. The old servicer usually sends one at least 15 days before the transfer date. The new servicer sends one within 15 days after the transfer date, or they can send a combined notice 15 days before the transfer. These notices have to include key info like the effective date of the transfer, contact information for the new servicer, and instructions on where to send payments during the transition.
Wow, okay. RESPA really does cover a lot, from the initial closing costs and banning kickbacks all the way through managing the loan for potentially decades after closing. The sources also mentioned RESPA has rules about appraisals, too.
Yes, it does. RESPA includes rules aimed at ensuring appraisers can do their jobs independently without pressure. It prohibits anyone involved in the transaction from trying to coerce or improperly influence an appraiser to hit a specific value.
So you can't pressure the appraiser.
Right. Appraisers and the appraisal management companies, or AMCs, that lenders often use, must be independent. Lenders generally can't use an appraisal if they know there was coercion or a conflict of interest that materially misstated the property's value. Falsifying or materially altering appraisal values is also prohibited, and there are requirements for reporting appraiser misconduct. Plus, appraisers who aren't direct employees of the lender must be paid a reasonable and customary fee for their work.
Makes sense. And finally, RSPLs also touches on homeownership counseling lists.
Yes, for most federally related mortgage loans, though typically not reverse mortgages or timeshare loans, lenders have to give applicants a list of HUD-approved homeownership counseling organizations in their local area. This list helps borrowers find independent resources if they want advice. The lender has to provide this list pretty quickly, usually within 3 business days of getting a loan application or enough information to constitute one. And the list itself needs to be current, based on info from the CFPB or HUD that's no more than 30 days old.
Okay, so TILA focuses on disclosing the cost of credit. RESPA focuses on transparency in the settlement process, banning kickbacks, and setting rules for loan servicing. They seem like two sides of the same consumer protection coin.
They really are. Both are complex, yes, but they form the bedrock of consumer protection in mortgage lending. Understanding their purpose and their key requirements, even if you don't memorize every single regulation, lets you navigate transactions more confidently, spot potential issues, and ultimately better protect your client's interests.
Now let's bring it all together. How do these two big laws, TILA and RESPA, actually show up in the paperwork your clients will see? This brings us to the TRI-D rule, right?
Yes, TRI-D. That stands for the TILA-RESPA Integrated Disclosures Rule. It was a major overhaul put in place by the Consumer Financial Protection Bureau, the CFPB, a few years back. The whole point was to simplify and combine some of the key disclosure forms required under both TILA and RESPA. It applies to most closed-end mortgage loans, so typical home purchase loans and refinances.
So it took old forms from TILA and RESPA and basically merged them into new, hopefully clearer forms.
Exactly. It got rid of the old initial truth in lending statement and the final HUD-1 settlement statement that was a RESPA form, and replaced them with two main integrated forms, the loan estimate, or LE, and the closing disclosure, or CD.
Okay, the LE and the CD. What actually triggers the need for these tri-forms? When does the lender have to start using them?
The trigger is when the lender receives an application. And the TRI-D rule is very specific about what defines an application. It's when the creditor has received 6 key pieces of information from the consumer.
6 pieces. What are they?
They are the consumer's name, their income, their social security number, which is needed to pull a credit report, the property address, an estimate of the property's value, and the mortgage loan amount the consumer is seeking. Once the lender has those 6 pieces, the clock starts ticking. They generally have 3 business days to provide the loan estimate.
Got it. The 6 pieces start the clock. Okay, let's look at that first form, the loan estimate, the LE. What's its purpose and when does the client actually get it?
The main purpose of the loan estimate is to give the consumer a clear, easy-to-understand summary of the key features, the estimated costs, and the potential risks of the specific loan they've applied for. It's designed up front to help them compare different loan offers from different lenders. And as we said, the creditor has to provide that LE no later than 3 business days after they receive those 6 pieces of information that make up the application.
3 business days from application, quick turnaround. What kind of information is actually on the LE? What does it look like?
The LE is typically a 3-page document. Page 1 gives you the high-level overview. It has general info, lender name, borrower name, property address, date. Crucially, it features a loan terms table. This shows the requested loan amount, the interest rate, and the initial monthly principal and interest, P&I payment. And it clearly flags if the loan amount, interest rate, or that P&I payment can increase later on, like with an ARM. There's also a projected payments table. This breaks down the estimated total monthly payment over the life of the loan, showing P&I, plus estimated mortgage insurance and estimated escrow amounts for taxes and homeowners insurance. Again, it notes that these amounts can increase over time. And finally, page 1 gives you a quick summary of costs at closing, the estimated closing costs total, and the estimated cash to close figure.
Okay, so page 1 is like the snapshot. Loan basics, estimated payment, estimated cash needed at closing. What's on page 2?
Page 2 drills down into the details of those estimated closing costs. They're itemized and broken down into 2 main sections: loan costs and other costs.
Loan costs versus other costs.
Right. Loan costs typically include things like origination charges, fees charged directly by the lender or mortgage broker. Then there are services you cannot shop for and services you can shop for. Other costs include things like taxes and other government fees, think recording fees, transfer taxes, then prepaids, like upfront homeowners insurance premiums or property taxes collected at closing, the initial escrow payment needed at closing, and potentially other miscellaneous costs. And the fees are shown based on who is estimated to pay them: the borrower, the seller, or maybe others.
Okay, you mentioned services you cannot shop for versus services you can shop for. What's the difference there, and why does that matter to the client?
Good question. Services you cannot shop for are typically services where the lender requires the consumer to use a specific provider they choose. Common examples are the appraisal fee, the credit report fee, maybe a flood determination fee.
Got it. Lender chooses.
Right. Services you can shop for are settlement services, where the lender gives the borrower a list of approved providers, but the borrower is allowed to choose their own provider for that service, potentially finding a better price. Things like title insurance, settlement agent fees, maybe a pest inspection. This distinction is important because it flags for the borrower where they might have some control over the costs and could potentially save money by shopping around. The LE shows the estimated cost for both categories.
Okay, that makes sense. And page 3 of the loan estimate.
Page 3 provides some really important comparisons and other required disclosures. There's a comparisons table that shows over the first 5 years and over the full loan term how much total principal will be paid down and how much total interest will be paid. It helps visualize the long-term cost. There are other key disclosures too: notices about the borrower's right to receive a copy of the appraisal, potential risks associated with refinancing later, a note about whether the interest might be tax deductible, which, as we mentioned, the IRS allows for home equity debt used for home improvements sometimes. It also includes contact information for all the key parties: the lender, any mortgage broker involved, the real estate agents for both buyer and seller, and the settlement agent. And there's usually a link to the CFPB's website for more consumer resources.
That's the LE, the estimate, provided early on. Now, the second big Tier ID form, the closing disclosure, or CD, when does the client get that one?
The closing disclosure, the CD, provides the final actual costs and terms of the transaction, not estimates, and the timing is critical. It must be provided by the creditor so that the consumer receives it no later than 3 business days before consummation.
3 business days before consummation. Okay, we need to define consummation carefully here. Is that the same day as the closing day when they get the keys?
This is a really crucial distinction under the TILA rules. Consummation is not necessarily the same thing as the closing date. Consummation is legally defined as the time when the consumer becomes contractually obligated to the creditor on the loan. When exactly this happens depends on state law.
So in California?
In many states, including California, consummation typically occurs when the borrower signs the key loan, documents the promissory note, and the deed of trust. The closing date, on the other hand, is usually when the property transaction itself is finalized, often when the deed is officially recorded. So frequently in California, the signing appointment where the borrower becomes legally bound to the lender is consummation, and the actual recording and transfer of keys might happen a day or 2 later. The critical point is the CD must be in the borrower's hands at least 3 business days before that signing appointment where they become obligated on the loan.
That's a really important timing nuance. The CD has to be received and reviewed before they sign those final loan papers. Okay, what does the CD actually look like? Is it similar to the LE?
Yes, the CD generally follows the same structure as the loan estimate, which helps with comparison. But it shows the final actual figures instead of estimates. It provides a detailed breakdown of the final closing costs. It includes detailed summaries of transaction sections for both the borrower and the seller, if it's a purchase. These itemize all the money coming in and going out for each party, things like the earnest money deposit, the final loan amount, any credits from the seller, prorated amounts for taxes or HOA dues, payoff amounts for existing liens, etc. It all leads down to the final calculation of cash to close. the exact amount of money the borrower needs to bring to the closing table, or in some cases, the amount they might receive back.
Okay. And what's on the last page, page 5 of the closing disclosure?
Page 5 contains some important final loan calculations and other disclosures. It shows the total of payments, that's the total amount the borrower will have paid in principal, interest, mortgage insurance, and loan costs over the entire life of the loan if they make every single payment as scheduled. It reiterates the final finance charge, the amount financed, we do the loan amount minus certain prepaid finance charges, the final APR, and also the total interest percentage, or TIPI.
TIP. What's that?
TIPI is the total amount of interest the borrower will pay over the loan term, expressed as a percentage of the loan amount. It gives another perspective on the cost of borrowing. Page 5 also includes other disclosures, like whether the loan has risky features like a demand feature or negative amortization. And it includes important notices about getting appraisal copies, liability after foreclosure, which can be particularly relevant depending on California's specific anti-deficiency laws, though the sources didn't detail that specific CA angle refinance risk and tax deductions.
Okay, so LE is the initial estimate, CD is the final actual costs, and that CD has to be delivered 3 business days before the signing consummation. What happens if something changes after the CD has been delivered but before they actually sign? Does that mess up the timing?
It can, yes. This is where the Tri-80 timing rules get even more specific. If certain key terms change after the initial CD has been provided, but before consummation actually occurs, it triggers a new 3-business-day waiting period. The consumer has to receive a corrected CD reflecting the change, and then wait another 3 business days before they can consummate the loan.
What kind of changes trigger that new waiting period?
The rules specify 3 main triggers for resetting the clock. 1. If the annual percentage rate, APR, increases by more than a certain tolerance level, usually 0.18% for most fixed-rate loans, or 14% for most adjustable-rate loans. 2. If the basic loan product itself changes, like switching from a fixed rate to an adjustable-rate loan. Or 3. If a prepayment penalty is added to the loan.
So, if the APR jumps significantly, or the loan type changes, or they add a prepayment penalty, boom, the clock resets. The client gets another 3 full business days to review the new CD before they can sign.
Exactly. It's designed to give the consumer adequate time to absorb these significant changes before they become legally bound. Now, other types of changes may be minor adjustments to fees that don't significantly impact the ABR, or changes that don't involve adding a prepayment penalty or switching the loan product might still require a corrected CD to be issued, but they don't necessarily reset that 3-day waiting period as long as the corrected CD is received by the consumer at or before the consummation appointment.
Is there any way around that 3-day waiting period for the CD? Can a client waive it if they're in a huge rush?
Yes, but only under very specific, limited circumstances. The 3-business-day waiting period for receiving the CD before consummation can only be waived by the consumer if there's a bona fide personal financial emergency.
Like what?
Like the imminent foreclosure sale of their current home, for example. It has to be a truly urgent situation. And the waiver itself has specific requirements. It must be in writing. It must specifically describe the emergency, state clearly that the waiting period is being waived, and it has to be signed by all the consumers who are primarily liable on the loan. It's intended to be rare and used only for genuine emergencies, not just for convenience.
Makes sense. And the lenders, they have to keep records of all this paperwork, right? The LEs, the CDs.
Oh, yes. Creditors must keep evidence showing they complied with TILA requirements for specific periods. For most general TILA disclosures, the record retention period is 3 years. But for the closing disclosure and any related documents showing how those figures were derived, the retention period is longer. It's 5 years after consummation.
Okay. So TILA and RESPA, kind of woven together now by the tree braid rule, create this whole framework of disclosures and timing requirements, all aimed at protecting the consumer.
That's the goal. It's all about ensuring the borrower is fully informed, understands the costs and risks, and has time to review everything before they make what is likely one of the biggest financial commitments of their lives. Now, as an agent, you're not the one preparing these forms, it's the lender's job, but understanding them. That allows you to answer basic client questions, maybe spot potential red flags if something looks off, ensure your clients are actually receiving them on time, and know when to firmly direct them back to their lender for specific explanations of the numbers.
Think like an agent. Okay, let's put this knowledge right to work. Imagine you've got first-time buyer clients. They got approved for an FHA loan. They get their loan estimate and they call you up totally confused. They're asking about this mortgage insurance premium listed on page 1, and especially why it seems to last forever, unlike their friend who has a conventional loan and expects their PMI to drop off eventually. How do you use what we just talked about to help them understand what they're seeing?
Okay, good scenario. You'd tap into your knowledge of FHA loan specifics that we discussed. You'd explain, okay, remember we talked about FHA loans. They require mortgage insurance, and it has two parts, that upfront premium and the annual premium paid monthly. Then you'd address the duration. Yes, you're right. For most FHA loans today, that annual MIP, the monthly part, typically does last for the entire life of the loan. That's different from PMI on conventional loans, which usually can be canceled once you reach about 20% equity. You point them to where this cost is shown on their loan estimate, page 1 and page 2, and just emphasize that this is a key characteristic of FHA financing they need to factor into their long-term cost comparison. You're not advising them whether to take the loan or not, but you're explaining what that disclosure form is showing them based on the specific loan type they chose.
That really clarifies the disclosure based on the specific loan product.
Good. Now, what about applying the RESPA rules in practice? Ethical compass. Let's talk our RESPA Section 8, again, the anti-kickback rule. This is absolutely critical. Imagine a title company representative, maybe someone you meet at an open house, tells you they'd love to send you a thank you gift, maybe a nice gift card, or calls it a marketing fee for every client you send their way for title or escrow services. Using your solid understanding of Section 8, what do?
You say no, right? Politely but firmly.
Absolutely. You politely but very firmly explain, look, I appreciate the thought, but accepting anything of value, regardless of what you call it just for referring business, is prohibited by federal law, by RESPA Section 8. Any compensation has to be for actual services rendered in the transaction. You just shut it down cleanly. Knowing and stating that rule protects you from potentially serious legal trouble, and more importantly, it reinforces your commitment to ethical practice and always putting your client's best interest first. It's just a non-negotiable line in this business.
That ethical clarity is just foundational.
Mm-hmm.
So, stepping back, how does really mastering all these financing concepts, the loan types, the CA deed of trust, TILA, RESPA, TRI-VUD, how does it help you build your actual business and connect better with your clients?
Adapt and connect. Well, understanding these nuances makes you incredibly adaptable as an agent. You can work much more effectively with a wider range of clients because you actually understand the different financing paths available. You can help a veteran client navigate the specifics of their VA loan benefits, guide a first-time buyer through the pros and cons of an FHA loan, or work smoothly with a well-qualified buyer who's opting for a conventional loan. You can speak intelligently, not as a loan officer, mind you, but intelligently about the likely options based on a client's potential profile and needs.
So you're not limiting yourself in who you can serve effectively.
Exactly. And maybe even more importantly, your ability to connect with clients and build genuine trust is significantly enhanced. Think about it. When you can walk a client through the complexities of their loan estimate or closing disclosure, when you can clearly explain what cash to close actually means, or clarify the difference between services you can shop for and cannot shop for, or explain why a California deed of trust is different from a mortgage they might be used to.
Yeah.
Those moments build immense value. You transform yourself from someone who just shows houses into a truly knowledgeable guide who helps them navigate the entire, often intimidating process. You reduce their anxiety, you build rapport, and you become an indispensable resource for them.
You become their trusted advisor in what can feel like a really confusing landscape.
Precisely. You're not just facilitating a sale, you're empowering them to make informed decisions about a massive financial commitment. That's huge.
Okay, let's try and recap the essential map we've sketched out today during this deep dive into financing.
All right. We kick things off with the basic why. Why do most people need financing? Bridging that gap between savings and home prices. And we talked about the lender's crucial role in evaluating risk through underwriting, looking closely at income, debt, and credit history.
Right. Then we identified the core promise to pay back the loan, the promissory note, and explored how that debt gets secured by the actual property through legal instruments.
And we put a big spotlight on the CA corner,
Oh.
emphasizing that California predominantly uses the deed of trust. Remember the three parties, trust or beneficiary trustee, and the huge implication of that structure, the non-judicial foreclosure process, using that power of sale clause, which is generally faster and outside the court system compared to judicial foreclosure under a mortgage.
Huge difference. Then we navigated the different paths to getting that financing, the common loan types. Conventional loans, set by private lender standards, often needing stronger credit and maybe 20% down to avoid PMI. Then FHA loans, great for accessibility with lower down payments, more flexible credit, but requiring that often lifelong mortgage insurance premium.
Right. And VA loans, offering those incredible benefits like potential $0 down and no monthly mortgage insurance for eligible veterans and service members, but having the VA funding fee. We saw how each really serves different borrower needs and profiles.
Then we dove deep into the consumer protection laws. First, TILA, the Truth in Lending Act, all about transparency and credit costs, primarily through disclosing the finance charge and the APR. It also governs specific disclosures, like for high-cost mortgages under HUPA, and it integrates with RESPA for those key forms.
And second, RESPA, the Real Estate Settlement Procedures Act, promoting transparency in the actual settlement costs, strictly prohibiting those illegal kickbacks and unearned fees under Section 8, that crucial ethical line for agents. And RESPA also sets comprehensive rules for mortgage servicing after closing, covering escrow accounts, handling errors, responding to information requests, rules for forced-placed insurance, early intervention for delinquencies, and loss mitigation processes. We also touched on RESPA's appraisal independence rules and the homeownership counseling list requirement.
And we saw how TILA and RESPA now come together under the TRID rule, which introduced those two essential forms. The loan estimate, LE, provided early on, and the closing disclosure, CD, delivered at least 3 business days before consummation. We broke down what information they contain and the critical timing requirements for delivering them, defining consummation, and understanding what changes trigger a new waiting period for the CD.
Phew. Yeah, that's a lot, but it's the core framework.
It really is. And this foundational knowledge, it's not just about passing an exam or getting your license. It really feels like the essential toolkit for building a confident, ethical, and ultimately successful real estate practice here in California.
It absolutely empowers you. It lets you guide your clients to the financial heart of the transaction with real clarity and integrity.
So with this deep dive into financing under our belts, where might you, our listener, take your learning next? What builds logically on this?
Well, based on what we covered today, a really logical next step could be delving deeper into the nuts and bolts of the escrow process itself, specifically in California. How does the neutral escrow holder manage all the funds, coordinate between all the parties, buyer, seller, lender, agents, and make sure all the conditions in the contract are met before the deal can actually close?
That sounds useful. Or maybe focusing specifically on the closing process itself. Tracing the steps from when the purchase contract is accepted all the way through the final recording of the deed. Understanding the timeline, the sequence of events, and the specific roles played by everyone involved, the escrow officer, the title officer, the lender, and us, the agents. And seeing exactly how that closing disclosure fits into that final exchange of documents and funds.
Or another angle could be digging a bit deeper into specific lender underwriting practices. We touched on income, debt, and credit, but you could explore common qualifying ratios in more detail, like debt-to-income, DTI thresholds, or loan-to-value LTV limits, and how lenders use those numbers to make approval decisions.
Lots of directions to go, but you've definitely taken a significant step today just by working through this financing landscape with us. It's complex, no doubt, but it is absolutely learnable.
Absolutely. And the key now is to put this knowledge into practice. Go back, review your notes, especially on those TILA-RESPA timings for the LE and CD. Those deadlines are critical in real transactions. Think about how you would explain the difference between a mortgage and a California deed of trust to a client using a really simple analogy. Practice explaining the key pros and cons, the main features of FHA versus VA loans.
Yeah, don't just study this stuff for the test. Try to integrate it into how you think about every potential transaction. Apply this knowledge not just to get your license, but really to serve your future clients with the highest possible level of competence and integrity.
That commitment, that's what really builds a lasting, successful career in this field.
Well said. Thank you so much for joining us for this deep dive into the world of real estate financing.
We really hope it's brought some clarity and maybe some confidence to what can be a pretty daunting topic.
Definitely. Be sure to subscribe and, hey, share this with others who are on their own real estate journey. We'll be back soon with another deep dive into the essentials of California real estate.
And maybe leave you with this thought. As the landscape of financial products keeps getting more complex and consumer protection laws continue to evolve, How will real estate agents like you need to continually adapt your role and deepen your knowledge to remain that truly indispensable, trusted resource for your clients in the years ahead?
Someone to think about. See you next time on The Deep Dive.